What if the greatest danger in finance isn't market crashes, inflation, or recession? There's a more insidious threat that quietly undermines our financial systems: the erosion of trust. Trust is the invisible glue holding the financial edifice together. Without it, the gears of finance seize up, creating a paralysis. We will delve into the heart of finance's biggest challenge: the alarming decline of trust. It directly impacts you, your savings, and your future. If trust evaporates, the entire system begins to unravel. The whole structure becomes dangerously fragile. Understanding this crisis is the first step towards addressing it effectively. Finance operates on confidence, built on promises and expectations. Investors, consumers, and institutions must trust each other. Over the past decades, this trust has eroded due to scandals and crises. The dot-com bubble, the 2008 meltdown, and crypto upheavals have left scars. This decline is fueled by misinformation, technological disruption, regulatory gaps, and economic inequality. These forces create a vicious cycle, making rebuilding trust a daunting task. Welcome to the modern world of financial guidance. In today's digital age, advice about your money is practically unavoidable. Open TikTok, and you'll find a teenager predicting the next crypto explosion. Scroll through YouTube, and a self-proclaimed guru will offer you guaranteed stock picks. Dive into Reddit or Twitter, and you're instantly swimming in a sea of tips to instant wealth. But how much of this wisdom is actually credible? The internet has democratized the ability to sound like an expert without qualifications. The promise of quick riches is powerful, making people vulnerable targets. It feels like trying to find a single drop of clean water in an ocean of contaminated sludge. How is anyone supposed to sift through the endless stream of conflicting opinions and outright scams? This isn't just harmless chatter, it can have devastating real-world consequences. People's savings can be put in severe jeopardy by following some charismatic online charlatan. It turbocharges the spread of dangerous financial nonsense. The GameStop saga of early 2021 perfectly illustrates how financial misinformation can ignite an inferno. What began on Reddit's Wall Street Bets forum quickly morphed into a global phenomenon. It was framed as a dramatic David versus Goliath narrative. The situation escalated with breathtaking speed, fueled by internet hype and emotionally charged rhetoric. The fear of missing out reached fever pitch, drawing in new investors. While some made profits, many others piled in at dangerously inflated prices. When the stock price plummeted, the losses were catastrophic for countless individuals. The GameStop frenzy served as a stark spotlight on the vulnerabilities in our modern information ecosystem. It demonstrated the dangers of herd mentality and a disregard for underlying financial fundamentals. It was a painful lesson that left a wake of financial devastation for ordinary people. Why does financial misinformation spread so fast, outpacing sensible advice? Lies are often more seductive, promising simple solutions and quick gains. Social media algorithms amplify sensational content because it gets more clicks. There's a powerful emotional component at play. Misinformation wizards tap into our desires for a better life, bypassing critical thinking. This constant bombardment makes promoting financial literacy an uphill battle. The noise of misinformation erodes our ability to discern credible sources. The cost extends beyond individual losses. Repeatedly being misled erodes confidence in financial advisors and institutions. It fosters cynicism, driving people away from legitimate opportunities. Technology is transforming finance at breakneck speed. Robo-advisors, high-frequency trading, DeFi, and cryptocurrencies are rewriting the rules. These innovations promise convenience and inclusion, letting anyone invest or bank from a smartphone. But the complexity is staggering. Most users and even institutions barely grasp the risks behind the algorithms and smart contracts they rely on. We're building financial skyscrapers on shaky, untested ground. The result? People and companies are diving in, often clueless about the dangers, lured by hype and fear of missing out. Financial firms rush to adopt new tech, sometimes without the expertise or safeguards needed. It's like being handed the keys to a supersonic jet after only riding a scooter. Cryptocurrencies and DeFi are the wild west of finance, full of promise but riddled with risk and fraud. The FTX collapse in 2022 showed how hype and lack of oversight can vaporize billions overnight. It wasn't a tech glitch, but old-fashioned fraud and chaos, hidden behind a charismatic founder and media adulation. Each scandal erodes trust, making it harder for real innovation to gain ground. The crypto world's lawless reputation scares off mainstream adoption and invites more bad actors. Every rug pull and exchange collapse deepens skepticism. Until trust is rebuilt, crypto's transformative potential remains out of reach. Now, artificial intelligence is shaking up finance, powering everything from lightning-fast trading to fraud detection. AI can analyze massive datasets, predict trends, and automate customer service, offering speed and efficiency humans can't match. But the black box problem looms. Even creators can't always explain how advanced AI makes decisions. In finance, this opacity is dangerous. Mistakes or manipulation could trigger flash crashes or systemic risks before anyone notices. The race to adopt AI is fierce, but oversight and transparency lag behind. The real challenge isn't just smarter AI but wiser, ethical systems with strong human governance. Without it, we risk unleashing forces we can't control. Building trust in AI means demanding explainability and accountability at every step. We're adopting new financial tech faster than we understand it, creating a dangerous gap. Institutions feel pressured to keep up, sometimes cutting corners and ignoring risks. Users dive in, often unaware of the pitfalls, making them easy targets for scams and losses. Regulators struggle to keep pace, leaving loopholes and vulnerabilities. This imbalance breeds fragility and erodes trust. Progress shouldn't mean recklessness. Transparency, education, and adaptive rules are essential. Without them, innovation could spark the next financial crisis. Regulators can't keep up with the speed and complexity of financial innovation. Innovators sprint ahead, while rulemakers are bogged down by bureaucracy and outdated tools. New products are so complex, even experts struggle to understand them, let alone regulate them. By the time rules are written, the landscape has already changed. This lag lets fraudsters thrive and risks pile up, threatening the whole system. The move fast and break things mindset is dangerous when people's savings are at stake. Without timely, effective oversight, the public pays the price for unchecked innovation. Regulatory lag doesn't just undermine trust, it enables the next crisis. If you want a textbook example of regulators playing frantic catch-up, look no further than the bewildering world of cryptocurrencies. These digital assets exploded onto the scene with the force of a financial supernova, promising to decentralize everything and mint new millionaires overnight. But while the hype train was thundering down the tracks, regulators globally were left scratching their heads, wondering what on earth they were dealing with. Is Bitcoin a currency? Is Ethereum a commodity? Are those countless other tokens, securities, utility tokens, or just digital Pokemon cards with delusions of grandeur? The fundamental questions of definition and classification remained hotly debated for years, creating a regulatory fog thicker than a London pea super. In the United States, this uncertainty manifested as a rather unedifying turf war between various regulatory agencies. The Securities and Exchange Commission, or SEC, often took the view that many crypto assets were unregistered securities. Meanwhile, the Commodity Futures Trading Commission, or CFTC, argued that some cryptocurrencies, particularly Bitcoin, behaved more like commodities. This alphabet soup of agencies, sometimes issuing conflicting statements or engaging in public spats, created enormous confusion. Businesses trying to innovate responsibly were left navigating a minefield of ambiguity, while less scrupulous actors happily exploited the regulatory gray areas. The direct consequence of this regulatory muddle is a deeply unstable environment for everyone involved. Investors are often left in the dark, unsure about the legal status of their holdings or what protections they are entitled to when things go wrong, and in crypto, things go wrong with alarming regularity. This lack of clarity doesn't just invite scams, it actively cultivates them. Furthermore, the absence of a harmonized global approach means that the crypto industry faces a patchwork of different rules, leading to regulatory arbitrage, where companies flock to jurisdictions with the loosest oversight, creating a race to the bottom. And please don't think this regulatory chaos only impacts the crypto bros. The spectacular collapses of entities like FTX, Celsius, or Terra Luna demonstrated that the shockwaves can be significant, wiping out billions in investor capital and severely denting public confidence not just in crypto, but in the broader promise of financial technology. When regulatory frameworks are slow to adapt, they fail to provide the necessary guardrails, leaving the door wide open for excessive risk-taking, fraud, and systemic vulnerabilities. This continued lag doesn't just make the crypto market riskier, it actively undermines trust in the ability of authorities to protect consumers in any rapidly evolving financial sector. It's not just cryptocurrencies. Consider buy now, pay later services. Platforms like Klarna, Afterpay, Affirm have exploded in popularity, particularly among younger demographics. They offer instant gratification and split the cost into easy, often interest-free installments. However, this convenience has emerged within a significant regulatory blind spot. Crucially, BNPL debt often isn't systematically reported to credit bureaus. This accumulated debt can remain largely invisible. This lack of comprehensive oversight and transparency creates a fertile ground for new forms of financial risk, especially for vulnerable consumers, and, in some cases, a quick slide into unmanageable debt, creating a modern-day debt trap disguised in a sleek, user-friendly app. The story of BNPL services is a classic example of innovation outpacing regulation. Let's talk about economic inequality. It's the growing divide between those who effortlessly surf the financial system and those who feel like they're sinking. It's about a fundamental disconnect in how the financial world serves the population. Since 2020, US billionaires have seen their wealth skyrocket by over $1 trillion. Millions grappled with job losses and inflation. Asset bubbles primarily shower wealth on those who already own assets. If you're on the outside looking in, you just see the ladder being pulled further out of reach. It impacts the perceived legitimacy and trustworthiness of our entire financial system. Is the system designed for broad-based prosperity, or to amplify existing advantages? Economic inequality erodes trust. For many, the financial system feels like an exclusive club with a strict door policy. Many are locked out from tools essential for building wealth. Employer-sponsored retirement plans are great, but what if your job doesn't offer one? Soaring housing prices shut the door for aspiring homeowners. Millions operate outside the formal banking system, relying on expensive services. How can they trust a system that doesn't provide basic services? This exclusion has a corrosive effect on trust. When people witness stark economic disparities and experience the barriers to financial participation, an almost inevitable perception begins to take root. The financial system isn't just unequal, it's fundamentally rigged. It's seen as a sophisticated game where the rules are written by and for the wealthy elite. This sentiment is becoming increasingly mainstream, fueled by observable realities. Think back to the 2008 financial crisis. Many ordinary people lost their homes and savings due to reckless behavior by large financial institutions. Massive taxpayer-funded bailouts went to those very institutions, while individuals were often left to fend for themselves. It cemented the idea that there's one set of rules for the powerful and another for everyone else. This perceived unfairness shakes faith in the fairness of the entire financial order. Let's be absolutely clear. This widening chasm of economic inequality isn't just a regrettable social issue or a topic for academic debate. As the original brief so aptly put it, it's a financial time bomb, ticking away beneath the glossy surface of our markets. The continued concentration of wealth and opportunity in the hands of a few, while the many feel increasingly left behind and locked out, creates profound instabilities that threaten the long-term health and viability of the entire financial ecosystem. This isn't about altruism, it's about recognizing a clear and present danger to the system itself. When a significant majority of the population stops believing that the financial system works for them, or that it offers a fair chance at prosperity, their engagement with it fundamentally changes. Some may simply disengage, pulling back from formal financial markets, reducing investment, and perhaps even curtailing consumption, which can create a drag on economic growth. Why save diligently or invest for the long term in a system you believe is designed to fleece you? This quiet withdrawal, this loss of active participation by a broad base of citizens, weakens the foundations of a vibrant economy. More dramatically, widespread disillusionment can lead to what the brief calls a revolt. This doesn't necessarily mean people grabbing pitchforks and storming Wall Street, though social unrest is certainly a possible outcome of extreme inequality. It can also manifest in a surge of support for radical political movements, the embrace of populist economic policies that might promise quick fixes but risk long-term instability, or a wholesale rejection of established financial norms and institutions. We might see a flight to unregulated, high-risk alternatives or a complete breakdown in the trust necessary for even basic financial transactions and agreements. This kind of reaction can destabilize markets and undermine economic progress far more effectively than any single market crash. Ultimately, tackling economic inequality isn't just a moral imperative or a quest for social justice, though it is certainly both of those things. It is a pragmatic necessity for ensuring the stability, resilience, and trustworthiness of our financial future. A system that is perceived as fundamentally unfair and that demonstrably excludes large numbers of people from its benefits cannot sustain trust in the long run. Rebuilding that trust requires more than just clever marketing or new financial products. It demands a genuine commitment to creating a more inclusive system where opportunity is more broadly shared and where everyone feels they have a stake in its success. This is the real investment we need to make. The challenges we face, financial misinformation, technological disruption, and slow regulatory adaptation, feed into one turbulent river: the crisis of trust. Every issue boils down to the erosion of trust. Trust is the invisible architecture supporting the entire financial edifice. When it cracks, those fissures spread, threatening the stability we depend upon. Consider investors from Wall Street to everyday savers whose capital fuels our markets. But when investors suspect the game is rigged, their confidence shatters. They doubt market fairness and investment safety. This loss of faith can lead them to pull back capital. What about ordinary citizens? We expect regulators to ensure a level playing field. When regulations lag, trust evaporates. It fosters a sense that nobody is in charge. And the everyday consumer? We entrust financial institutions with our money. But when data breaches occur, that trust erodes. Consumers become wary. It's a suspicion that institutions might not have our best interests at heart. Every financial interaction becomes a potential minefield. What happens when trust erodes across the financial landscape? Capital circulation suffers. Finance relies on channeling money to businesses and entrepreneurs to build factories, develop technologies, create jobs, and generate economic value. This system hinges on confidence. If investors lose faith, lenders fear repayment, and businesses distrust the outlook, capital flow ceases. Money gets hoarded, starving the economy of investment. Distrust chills innovation. Why invest in tech if the public is skeptical or regulators stifle progress? Change slows, leaving us with outdated systems. Constricted capital and stalled innovation lead to a bleak economic picture. Economies stall, job creation falters, growth slows, potentially into recession, living standards decline. Economic inequality converges to make the financial ecosystem fragile, constantly on the verge of breakdown. The system loses resilience. Small problems escalate into systemic crises. Everyone's savings are at risk. The structure becomes precarious. Rebuilding trust is essential for our future. After that tour through financial hell, from digital misinformation to tech running amok, you might be feeling bleak. These forces have eroded trust. What do we do now? Perhaps not all is lost. There's a path forward, demanding systemic change. Financial education must become universal, empowering individuals. Technological innovation needs transparency and ethical frameworks. Regulatory bodies must evolve to oversee emerging technologies. The financial industry's ethos must recalibrate to serve all people. Trust is built on accountability and transparency. Rebuilding trust is the most critical investment for our future.